Tutorial I'll be going through with you about Caterpillar stock, and just type Caterpillar stock in Google and you'll find this information. Caterpillar Inc. and its cat is the symbol, and it's 121.65 US dollar for one stock, and it's a billion market cap. So it's a big size firm, and the dividend yield is 3.39%. Any firm that is paying dividend, that means they're financially strong. No matter how less is the dividend, doesn't matter. It means they're financially strong, because after paying their creditors, loans, liabilities, they still have extra money left. That extra money they pay to shareholders as dividends. So this is a positive sign because they're financially strong. Let's go to Wikipedia and see when was this founded. It was founded in 1925, 94 years ago. Now I want to see what the employees have to say about this thing. I'll just copy this exactly from Google and I'll paste it here and type Indeed reviews, and I want to see what people have to say in Indeed. We have 5,800 reviews and 3.9 star, and you can read through the pros and cons yourself. Check out the salaries, the photos of the firm, the jobs listed, and the questions asked. Now I want to see the reviews in Glassdoor as well, and let's have a look. I can see that there are 3,900 reviews, and you can 3,900 reviews and 3.6 star. I can see, you can read through the pros and cons yourself, and the jobs that are listed, the salaries they're giving, the interview questions, the benefits they're paying, and the photos. Just go to Justia Patents and have a look at the patent, and I'll just paste it from the Google exactly. And I just want to concentrate on applicant or assignee, because these are people who have full rights of the patent. um, so I'm just concentrating on applicant or assignee. In 2013 they have a patent, 2012, 13, 13. They have a lot of patents. Just go through the list yourself. Please look out for recent patents in 2014, 15, 16, 17, 18, because that means they're still innovating. And the more patents a firm has, the more stronger it is in the market and the more harder it is to beat them. So it's very good. Caterpillar has a lot of patents, which is a brilliant news. 2010 they have a patent, 2011 they have a patent. So they have a lot of patent. That means they're very strong in terms of it's hard to beat these people. That's brilliant. Now let's go to Yahoo Finance, and I am interested in knowing their key executives and what salaries are they getting. Let's have a look. Now, don't be confused by which one to click. Just match the symbol and with the name. So I'm looking at cat because that's the one Google I got from Nasdaq symbol, and now I'm going to go to profile, and I can just show you briefly the industry, the employees, and you can see there are 5 key executives and all of their salaries have been shown. So they haven't hidden any salary from us. That's brilliant, because that means we're able to build trust. So we can see all the salaries. Now let's go to macro trend, and I want to show you the ratios. Click price ratio, price book ratio, and paste or type in the symbol. And if book ratio is less than 1, that means stock is cheap, it's a discount, it's a bargain, you must buy that time. And if it's more than 1, that means stock is expensive. The higher the number goes, the more expensive it gets. Be patient with this website, because sometimes it takes a lot of time to load because it has a lot of data, but once it loads, it makes your life quite easy. Please let me know if I'm going too fast in the tutorial. I'll slow down, or if you have any questions for me, or if you're stuck somewhere when researching for stocks. Okay, I can see we have 4.71, which means the stock at the moment on August 2019 is 4.7 times more expensive. Somebody who buys right now, they'll be paying 4.7 times more money. If you see in 2017 December, the stock is 6.65 times more expensive. Somebody who bought that time in December 2017 paid $153 to buy something that was $23 worth. It's a lot of money. And if I see the cheapest it was in 2009 March, when it was twice as expensive. Somebody who bought in 2009 March, they paid $21 to buy something that was $10 worth. Right now it's 4.7 times expensive. Now let's go to other ratios. I want to check out the current ratio. If the current ratio is less than 1, that means stock is risky, because liabilities are more than assets. If the current ratio is 1.5 or more than that, that means stock is safe. It has a good margin of safety. Right now it's 1.4. That means it's a little bit less than 1.5. So let's look at the previous trend. Has it ever been 1.5 or more than that? We have data since 2005 up till now. Since 14 years, it has never been 1.5 or more than that. So there's no margin of safety. There's no consistency in it being safe. So it's a risky stock, I would say. and except once or twice it has been 1.5 or more than that, which is, compared to consistency, there's no consistency. So I would say it's a risky stock. Let's go to debt equity ratio. This ratio will tell me if the company is mainly operating on debt or equity. I'm looking for zero point 0.5 or less than that for it to be very safe. Please let me know if you want me to make a tutorial on a particular stock. I'll make that for you. I'll do the research and I'll post it on my YouTube channel. And if you would like to connect with me, please let me know in my discussion channel of YouTube. Okay, I can see that we have 1.66 is the debt equity. I'm looking for zero point 0.5 or less to be for it to be safe. It's very dangerous stock right now because it's a lot more than 0.5. And if you notice, it's debt equity. Debt is more than equity right now, which is very dangerous. So companies mainly operating on debt. That's not, that's a risky stock. Let's look at the previous one. Has it ever been 0.5 or less than that? No, since 2005 March up till now, since recent 14 years, consistently it has been more than zero point 0.5. It's a risky stock in terms of debt equity. So it has taken a lot of debt compared to equity, and it's a very risky stock in terms of that. So let's go to return on equity. I'm looking for 8% or more than that for it to be brilliant. Let's have a look. Once it's loaded, I'll let you know. Okay. So I'm looking for 8% more than that for it to be brilliant. Right now it's more than 8%. It's brilliant. Let's look at the previous trends. Has it ever been below 8%? So I can see that since 2005 up till 2016 June, it has always been above 8%. That's brilliant news. But it came down in 2016, 17, and 16 and 17 for 2 years. It's even a minus, but then 2018 March up till now it's brilliant. It's more than 8%. So I might for 2 years it's fine because the previous trend is great, as well as the recent one as well. So that is fine for me. So overall it's brilliant in terms of return on equity.